All right. Good morning, everybody. We got Walmart earnings that moved the market a little bit. I know it doesn't seem like it should. It's no Nvidia, but it's a massive company, and everybody watches it for a signal on consumer spending. It's a part of their retail week, and we're going to get more retail numbers later today. But they came out with good numbers, and it's kind of interesting. I was doing a little bit of a deep dive on it, more of a follow up. I did a deep dive a few years ago. I really dug into this company. And a few years ago, their online sales were about 8% of their total revenue. And now they're at 15.4. That's almost 50% increase. And at the time, a couple of years ago, I said this was where they had the most room to grow, right? It was that online sales presence. And it's hard to imagine how they could grow against something like Amazon, right? I mean, you just you can't compete with Amazon. But they're doing it. They're doing a pretty good job of it. And as more of these apps get integrated, where you can be on Snapchat or whatever, and without leaving your social media, you can buy from the Walmart store. That is going to continue to grow, right? And then, of course, if you look at your own local Walmart, you can order things off the app and then drive in and get it picked up. I'm pretty sure they're counting that as online sales too. Still, there's room for expansion. 15% of its total revenue comes from online, and that still leaves a lot of room for improvement. I still like this company long term. So they had earnings today. It moved the market a little bit. And as you can see, I'm using AI for this. I continue to stress, if you're not using it even a little bit, then you're missing out. And I've talked to a number of people who say, "Oh, I don't want anything to do with that." Okay, you sound like the guy that's still riding around on his horse saying those weird metal contraptions that are noisy, those things called cars. You don't want nothing to do with it. You'll stick with your trusty horse. Yeah, well, good luck with that, right? If you're not messing with AI at all, not even a little bit, you're going to just get left behind. Simplify your life a little bit. Yeah. At least just take a load off. Let it do some of the heavy lifting. I'm done with my rant. So the markets liked it. Japan up 0.75%. NASDAQ, Dow, S&P basically flat. Small caps getting a gut punch, down more than 0.5% this morning. Hong Kong basically flat. It just kind of goes to show the fast mover in one direction was the quick one to flip. There's still a lot going on the small cap space, and I continue to get people asking, "Hey, I thought this was supposed to do good in a time like this, right? With the idea that we're going to be getting rate cuts and easing, aren't small caps supposed to do good?" And it's yes, but so there's more to it. It's not just as simple as that, and we're seeing it. We're going to get some jobs data today. It's not the big job numbers, but any job numbers at this point are going to be really important. And then, of course, we're going to get that retail data. We've got a Fed speaker twice today. Parker at 1 and St. Louis Fed at 10 after 9. Remember, when we get these Fed speakers off the cuff, it's not enough information. We need to know, is it a live meeting? Are they going to do Q&A? Because they can just send in a video recording, right? They don't actually have to have a live meeting. And then where are they speaking at? Is it, some lunch at a college? Probably won't move the markets, right? So where they're having their meeting and what their topics are, whether it's live, if they're going to have Q&A, those are the sorts of things that you want to do a follow-up on when you see that there's a Fed speaker. And then tonight we've got Japan data, and this one I think can move the markets too. Also, it was announced that we're going to see another prime minister, and I was doing some background on that yesterday. They had a prime minister that was in for almost a decade, right? And then he got out, and since then we've had just like this revolving door of prime ministers, and now we're going to get another one over there. And there's still a lot that they got to try to work out. Maybe the next one won't be so accommodating, right? When they were supposed to change rates and they backed off because of the volatility and they bowed down to markets. Maybe the next guy won't. This was the impact from Walmart and its earnings. Not a lot, right? But it's not NVIDIA. So kind of take it with a grain of salt. All right, as we've been doing the last few mornings, we're basically starting right in the middle of these two red lines. That leaves us in a hurry up and wait mode. If it would lean to one side or the other, it would give us some indication of which red line we're going to hit. And we continue to see the ADR fade, right? This is a snapshot over the last 21 days of how far the market has gone from its highest to its lowest point on a day-to-day basis for the last month. If we spend a couple days making really big moves, then it expands and we find it above 100. After that, if we spend a couple days going sideways and not really making gains in one direction or another, it starts to fade off. It's down about 3 points compared to yesterday. We're going to continue to expect this to fade until it's more in line with these other two metrics. But volatility is still high, and we're not talking about implied volatility or some kind of ATR volatility. We're just looking at the difference between how much we are moving on a day-to-day basis versus how much we're supposed to be moving on a day-to-day basis. And it's still 100% more than what we should be moving. Movement is volatility. So as long as it's that spread out, then there's still volatility there. Once we get back down below, say, $15, then we could say that we're, back into a more normalized volatility. But this is just a snapshot of where we are, right? It's like a gauge, and it's not a perfect gauge. There's a lot of ways to read volatility and to, kind of measure the type of volatility that we have and how much we're moving on a day-to-day basis. To me, that's like a raw volatility, unfiltered. You can clearly see the difference. So we tested an inside day breakout. That didn't work. But we continue to hold the high too. We got to assume that there's a lot of liquidity up here. Remember, liquidity resides on the other side of the pivot. When you get something like a double top and price pulls around and comes back to that top, liquidity is above it. So we call this a bull trap. We need price to go up there and break through the previous high, go higher, trap the bulls, and then we dump it on them. It's not a bull trap if we don't get the breakout, right? If we just come up and tag the same spot as we tagged before, it's not a trap. The bulls aren't going to fall for it. We're not into new territory. There's no breakout. There's no bull play. If we come up and we hit a level and then we match that same level, well, it's more of a cup and handle than it is a double top. Double tops are supposed to go back down. Cup and handles pull back and then get the breakout. So we have to get through this zone until we're done with those sellers up there and we've absorbed all of that liquidity. We're not going to make it through. But price isn't giving up. True, we are getting these lower lows. After testing this zone, we really fell back. But we're continuing to run back up there and gather more of that liquidity. If we can get enough of it done, there's not anything left and we're able to cut through it. 54.92 is also a cog line. It's easy enough to recognize that that was an area of resistance just because of the cog line, but also because liquidity resides on the other side of the pivot, which we can recognize just by putting on a fib and looking at where the 111 is. That zone is your sell zone. So we can watch the dome, look at the pace of the tape, see the orders coming in as we get into this sell zone, and look to see if they start moving out of the way, or that we absorb everything that's there and then we're able to continue on higher. Now that we've made new highs, though, there will now be liquidity on the other side, right? So now it's going to be even more difficult to get into that 55 area. I would say if we can get through 5,500, it gives us a clear shot to 55.31 cog line. Sure, we've got 55.11 that we would have to deal with. And I think there's a halfback in the middle of all of that we'd have to get through. Yeah, it's 55.11. So the halfback, or the 50% mark, 55.11 cog, lines us up really easy. If we can get through 32, then we got 55.82, even higher. And if you're thinking, no way, man, that's way too far away, we can't do that. We've got an average daily range of 100. That's what we've been doing on average. And from where we closed last night at 6 o'clock, 100-point move gets us to 55.82. So, yep, we can do it because we have been doing it. Although these two tags both say we shouldn't get farther than the ADR if we're going to do what we're supposed to do, which is just our average range cut in half. So we still have this pure price issue. This isn't resolved yet. And until it's resolved, we still don't have a known answer here. They say that you pay for confirmation, right? And that's 100% true. By the time we finally get confirmation that this isn't just a dead cat bounce and that we're not going to just roll over and go down, we're going to be so far from this low that any stop you would want to use, say this was a stock, right? And you're getting in now that you finally have confirmation that it's not a dead cat bounce. It's so far away from this pivot point that you don't have a good spot for a stop. Whereas if you'd have got in along these lows, although that would have been a quote more risky trade because you don't yet have confirmation, you'd have much less risk in the trade because you could use a much smaller stop. So we still don't have confirmation yet that this isn't just a dead cat bounce. We still got to get above this level and close up there, and or we still need to fall down and set a higher low. One of those two things has to happen, and they haven't happened yet. So until one of those two happens, we still don't have confirmation, and this could still just be a snapback rally into resistance before we roll over and retest this low, maybe even continue lower. From a pure price method, that's where we're at. Now, if you want to use things like indicators, MACD, RSI, moving averages, all of that, there's a lot of things that say that the rate of change and the momentum is picking up and that this looks really good and we're continuing to get higher highs and higher lows, and right, it's all there. Moving averages are crossing back over, price is getting back through all of them, which is why just doing one thing like pure price kind of leaves you blind to what the others are doing. If you combine them both, then you can start to ease in early, right? A little bit at a time. So it's still the same situation. 5,600 and above, close up there, and or get that pullback that we're all waiting for. Find a low that's higher than this last low, and then rise up off of that and break this high. So we would need to fall back and then rally up and break that. That would give us this higher low, and it would give us a new higher high. And then we wouldn't need that one necessarily anymore. So we got our floor pivot today. It's not as big as a channel as we had yesterday, but it's still a pretty wide channel. So while it's outside of yesterday's range, they're not touching. It's above, which is bullish. Price is above that, which is bullish. With a range channel like this, then we would expect that breakouts don't stick. Now I'm going to continue to argue that these do not see what price is really doing. It doesn't recognize the volatility that we have, which is why we've seen really big moves, even with a wide channel, right? So in the current volatility, this wouldn't be my only tool to try to gauge if today could be one of those days that we expand. This is the weekly pivot, 52.90, and we're at 54.90. It's a 200-point move away from our weekly pivot point, and we started the week above it in the first place. I don't think we have much more room that we can drive to the upside away from that weekly pivot. I don't have a way to quantify how far is too far, and I've tried different metrics. Nothing that I've got so far works other than just measuring them all by hand and then putting in the formula. I don't want to do that. But it's gotten to the point where when we're 200 plus points away I start to consider how much farther can we get from this thing and what kind of push would it take? It can't just be a drive from the market. And the analogy that I use would be a runner climbing a hill or running up a hill. And the higher they run, the more weight we stack into the backpack that they're carrying as they run. Could they still run? Yes, but it's going to take a lot more effort. Could this break out and go even higher from here? Yes, but it's going to take a lot more effort to do that breakout than it did to do a breakout all the way back here when we were a lot closer. Right? That makes sense, hopefully. I think we're about there. So when we put it in that context and we say, okay, we're there, that doesn't mean we have to fall. We are outside this box, however. This is our range for the week. We're supposed to close inside this box 70% of the time as a 1 standard deviation calculation. The S&P generally is more accurate than that and stays inside this box at Friday's expiration 80% of the time. So, 70 to 80% chance we close inside this box. Well, that means we go down before Friday's close and we set that lower high pivot that I was just talking about, right? Kind of puts some of the pieces together. We still don't have the AM edition of the Founders Note yet. So maybe we'll get a little clarity when that comes out. And we have the 50-period moving average right over our head. So that's something, even though we've crossed through it multiple times, it's still something you want to have on your radar, right? And if you want that 50-period moving average on your intraday chart, type in the word daily, and you can see you get a moving average that you can put on there. It is the simple moving average. It's not the exponential, and it's right there. Remember, 5511 is a cog line. That's 5509. It's really close to where that cog line is. On TradingView, most of the default moving averages has that ability. So you can do it on TradingView too. Trade of 8's got it. Most of them do nowadays. We have a profile here that we have to be worried about. There's a point of control. It's a point of control for the week instead of just the day. And it's right around that 5511 area. Imagine that. 5508. So not spot on at 5511, but it still highlights that whole zone. It's a high volume area. It's the point of control for the entire week. It's going to be difficult to get through that level, whether it's, trader's remorse or just revisiting a level that had a lot of trading activity. Either way, I think that's going to be it right there for the week. Now, next week, yeah, okay, we could do something else next week. So one of the things I'm looking at for the rest of this week is to put some sort of spread up here, whether it's, a call credit spread or maybe a butterfly if we think we could actually pin up there, or a butterfly with a credit spread. That way, credit spread pays for the butterfly. Something to think about. Not getting through this level does not mean bearish, right? It's not like I want to buy a put or something because, well, this doesn't mean we're going down. Just that it would be hard to get through this level by the end of the week. Price has this tricky little habit, if it's got a major resistance level, it'll jump that level after hours. So technically it's possible for us to get through this level before the end of the week. But that would get us so far from the weekly pivot point that I don't think it's sustainable, and we would snap back anyways. Volume's normal, sitting in the 70s. We've got a lot of support underneath this, the 10-week, the 20-day, the 10-day, the 3-week. So a lot of structure down there to hold us up, and we're about to get a 310 cross. If you've done any work with moving average pairs, there's what we call the surge signal, and it's when the 3 and the 10 cross. If the 3 crosses up through the 10, it's a bullish surge, and if the 3 crosses down through the 10, it's a bearish surge. Well, if we're getting a weekly 310 cross, that'd be bullish if it's crossing up, bearish if it's crossing down. It's crossing up. The point of control here on this 10-day, 30-minute volume profile isn't likely to move anytime soon. The only way I could see this moving is if we do hang out here around that 5,500 and we end the week here. Because if we spend another day and a half, we're liable to build this area up enough to move this point of control up to that location. If we fall away from this zone, we're no longer building structure up here. And if we break above it and continue to run, then we're no longer building structure up there. And the point of control that we have isn't going to move. It's going to stay right there. It's going to take weeks for us to get to this location and remove this price off of the table. And that's where a lot of this volume comes from. Sure, there's some from way back here. That can't be discounted, but that's not all of it. Most of it's right here. And it's going to take weeks to get there. So the only way we're going to see this point of control move is if we stay in one spot long enough and build a new section out. So that puts another really solid level of support underneath this. I mentioned the other day that we need to get far enough away from this before we could actually consider it support. And until we did, that we could just cross back and forth and it wouldn't be supportive. Well, we've done that. We're far enough away now that if we come back to it, we would look for it to provide support. All right, we got a 5x5 here. 5-day, 5-minute chart. We hit the VPOC during the econ yesterday. We hit it. Then later in the day, we came down and we hit it again. So we're done with this one. We're just going to go ahead and set it on yesterday's price since we have a new VPOC there. That'll work. 66 or 67. And then we hit 54.72 yesterday. also during the econ. So we hit both sides. That's wild. Get that out of the way. So if we do fade today, this is just another bit of structure that's underneath this. We have all those moving averages and the 10-day profile point of control and yesterday's VPOC all stacking up as a supportive structure underneath this. So we could go down, but I think it would take another exaggerated market event, some kind of news, a catalyst. I don't think we could go down just because, right? It's not, that wouldn't be strong enough. Staying above the 10-week is a good start, just being back above the 0. But our good spot is between, say, 3.5 and 1.5, this zone here. It's kind of where we want to be, want to maintain that. So we're still moving back up into position. Everything's fine, everything's healthy. We haven't moved too far, too fast, even though it may seem that way. We're not overextended. We're really just coming back to the mean. We're coming back into position where we should have been all along. So while it may feel like we have really gone too far, we haven't. Now on the 10-day, we're about where we want to be. You can see we got into that level yesterday. We're there. We're about as far away from the 10 as we would comfortably want to get. We could overshoot it and go a little bit more, but we would snap right back again. Kind of like that distance from the weekly VWAP. How far can we get before we just can't go any farther? This says, yeah, we're there. Between this, the distance from the 10-day, and our current distance from the weekly pivot, I'd say it's going to be really hard to go any higher and keep it. We could wick up there. I just don't think we can keep it. So what that could end up looking like, actually, this is the wrong one. So we get this distance from the weekly pivot and it tries to go just a little bit more. Here, for an example, we already had our distance from the pivot. It seemed like that was all we're going to get. And it tried and it got just a little bit more. It wasn't able to keep it. It came back down and it tried again. And it wasn't able to keep it and it came back down. I think we could get, some of those kind of shenanigans for the rest of the week. And it lines up, right? That's a Thursday and a Friday, just like our current situation. We already made some good moves. We're holding these levels. We could get just a little bit more. I don't think we can keep it. Nothing is down this morning. Come on now. I don't believe it. Yeah, bonds are down. So TLT. And I only say that because the 10 years up. We're not actually looking at TLT. Yep. There's our fade from the close. It's not much. We closed at 97.90 and we're sitting at 97.60 this morning. So we're still inside day from yesterday, barely. Still well above the 10. Moving averages are spread out nice. Everything's looking really good on bonds, but I would expect another test of the 200. And for, we were talking about those bottom fishing recovery plays. I mean, bonds really fit the bill. I know it's not a comeback story like a stock, like Carvana or EDU, one of those turnaround companies that get its act together and has activist investors and all of that. But it has the Wyckoff beat down and the accumulation across the lows. And now we're starting the accumulation side. The 200 slope, it fits the bill perfectly. Bonds. So the 200 is just barely turning up. I would expect that we come down and try it again a couple of times, maybe. So don't feel like you got left behind and have to chase this thing. Selling some 90 puts, maybe 92 if you're not worried about owning this for a while. Lower that dollar cost average on the shares when you finally get it. So bonds are down a little bit. Un poquito. Everything else is either flat or up. Gold miners, staples, metals and mining. Not much for, like the Mag 7 semiconductors. NVIDIA's got this 2-bar resistance at 120. Google's still chopping around in its own range, which I really like this for a long on the assumption that they're not going to get broke apart, right? If that assumption is wrong, you're going to get murdered in that trade. Apple still grinding its way back up to where it was on the earnings or, before the earnings. That 224 is the line in the sand. Talk about having a wall of sellers. That 225, between 224 and 225, I think that's it. Now, can it get by there in time? Yeah. I don't think it's going to be August. It may not even be this year, but I think that's it. Amazon's got room with the halfback on the earnings candle. If it can get past that halfback, that 180 zone, then we could run up to 190 and get into those sellers. But that's if we can even make it through the half. It's a big if. Microsoft made it through the half of its earnings candle, but it still has that sell zone at the 430 area. We'll expect those sellers there if they don't front run it anyways and catch us at that 420 area. 420. Now take a look at Meta, where we would have expected those sellers. They just ground their way right up through it, right? This is a bullish grind, and it's why a bullish grind is such a great example of how we get through liquidity. If we spike up into that liquidity, say like these moves in Netflix, it'll very likely be rejected and we fall back down. But you take something like Meta, we got to that level where we expect all those sellers, and it was just a grind through it. Now we're there. We just got to close above that area, right? 530 would be the line in the sand. And Tesla's still a dog stuck inside of this 8-5 candle. So there isn't a lot of room for the Mag 7 to make gains at the moment. And if they're not carrying us, then what will? SMH isn't looking so hot this morning. TSM also. So we're not going to get any help out of Mag 7 or semis. Not yet, not right now. We've got precious metals like silver. Beautiful move in silver. That would be right up into resistance. Let's try a different one. So we got this. I don't think that's mine. Yeah, it's mine. We're gonna move that too. I thought it was one of these. With silver, we're just making these lower highs, lower lows. So we're on the run up. I would look for it to fail to get through this zone. If it does get through there, then we'll have our first higher high that we've had, in forever since we came down and got into that anchored VWAP. Same thing with gold and gold miners. They're up this morning. Nice pop, still inside yesterday's day, still setting lower highs. Yesterday is a really great example of that. It got near that area, but it didn't get through it. So that's a lower high. Lower lows. We're just working our way down. Lower highs. So we've got a bit of a run up this morning, but it's got to get through this entire wall of sellers. And even if we can do that, we've got these sellers up here still too. Nice move in crude this morning. Not really expecting much out of it. Back up into that 78, 79 area. Got a lot of work to do, and it's in the middle of nowhere. It's interesting to see China up with Baba having such a bad earnings this morning. Right? When I was digging into this before its earnings, their revenue looked really good, but their spending was just out of control. And my concern on this, and why I didn't go long for earnings, was that they would come out and say they spent X amount of money and the market wouldn't like it. And we've seen that a lot this earnings, right, from other companies. So that was my real concern here. And well, I mean, that's what we're getting this morning. Back down to year-to-date anchored VWAP. I wouldn't be surprised if we can cut through that, maybe get down into the 72 area, retest this low from earlier in the year. I don't think we're looking at a massive crash and burn on this thing because, I mean, they are making money. They're just spending a lot. But China is up. If you look at XFI, nice little gap up. And if China's up, you should see something like solar. So tan, maybe. Nope. Yeah, it's weird to see China up, but none of its proxies. Maybe something like Baidu. Nope. PDD. JD. Okay, so this is what's giving it a little bit of a bump. JD's got a little move to the upside, back into anchored VWAP. I wouldn't go long those China ones yet, right? It's not structured enough. And gold futures may be a shot, either the gold futures or the oil futures. If you're trading the futures and you're looking at the ES and it's sideways, or the NASDAQ today and it's sideways, if that's what we end up doing, maybe crude or gold would be a better play, right? Because shorting this high, maybe back down to the pivot point, because that's an MDP. We haven't hit it yet. Maybe that's a play, but then what? Once we set structure on the low end and the high end, we can just sit there and chop for the rest of the day and do nothing. And that's not much of a room, right? It's like 25 points. It's a really narrow range. Yesterday we had an MDP, and today, so far, we've got an MDP. Today's counts for tomorrow. Yesterday's counts for today. It just adds to that bullish structure, right? If you do want to tighten everything up, rather than using these big zones like yesterday, just use what we have in the morning market. There's your Globex range. Doesn't look like much in that context. Doesn't even get us to yesterday's low. So with these additional auctions, we got the 30-year today at 11 a.m. The 30-year is a big one, right? It's a big deal. Keep your eye on that one. But if we have them at 11, then we have them at 11:30, and we also have auctions at 1 o'clock. Pay particular attention to those. And then we've got data all the way out into 4 o'clock today, right? This is probably Australia or New Zealand. Yeah. PPI out of New Zealand probably isn't going to shake anything in the overnight hours. But Fed speakers, auctions, we've got things coming in all day today. Don't stop watching the news today, because it's going to keep coming. Be careful, be safe. I'll see y'all tomorrow.